Good morning, my name is Mekondjo Erastus. I do research at MONASA Advisory and Associates, and I'll be talking about responsible investment reporting. Thank you very much, Mona. Thank you, GIPF, for creating this platform for us. Yes, I'll be talking about responsible investment reporting. I'll just talk a bit about ourselves. We are MONASA Advisory and Associates. We're a research and advisory firm. We do transactional advice. Recently, we partnered up strategically with 6 Capitals from South Africa. They are a subsidiary of Alternative Prosperity, and they work with asset owners and managers in South Africa, offering responsible and impact investment advisory as well as ESG advisory services. We partnered up with them specifically to provide in-country capacity for ESG services, which is quite a big term. Some of the work we've already done with GIPF. We've recently conducted a study to quantify and assess the socioeconomic and ESG impacts of GIPF's 20 unlisted fund managers across GIPF's 5.5 billion unlisted investment portfolio of 56 investee companies and SPVs. So we've done a great baseline of the ESG practices of GIPF. So to unpack ESG and responsible investing, I'll have to just sort of do a situational analysis of global megatrends, some of which are obviously that we know: mass urbanization, population growth, climate change. I think I'm going to really dive into resource sort of efficiency because that links all of them together. If we look at our ecological footprint, which is the biological productive area needed to provide ecological resources, such as fish, wood, fibers, humanity's ecological footprint has been growing substantially since 1961. If you look at the graph, towards 1967, we've been actually running at an ecological deficit. So we are consuming more than the Earth can actually produce or replicate. Most of it's actually in carbon. 60% of the world's total ecological footprint is actually in carbon. So our carbon footprint is actually out of control at the moment. So as I said, basically we use more resources and services than we can regenerate. Through overfishing, overharvesting our forests and emitting more carbon dioxide into the atmosphere than the forest can actually sequester. So it's grown basically our footprint from 7 billion hectares to 22 billion since 1961. The Global Footprint Network estimates that as of 2013, which is an interesting statistic here, humanity has been using natural capital 1.7 times as fast as nature can renew it. So this means that humans on our Earth are acting as if we had 1.7 planets at our disposal. This is unsustainable. It really is. I suggest everyone should actually go to the Global Footprint Network website and do a footprint calculator to assess your own ecological footprint and assess your consumption. You might be shocked. But looking at Earth Overshoot Day, which is also on the Global Footprint Network, Earth Overshoot Day is basically the day of the year in which humanity's demand on nature exceeds the Earth's capacity to regenerate this demand over the course of the entire year. So our Earth Overshoot Day will fall on 22nd of August this year, meaning that between January 1st and August we will have demanded an amount equivalent to what the planet can regenerate. So we've actually depleted our budget for sort of consumption of the Earth by August 22nd. It's a bit later this year because of COVID-19. The world kind of stopped, so our consumption actually went down. But by August 22nd, we have basically, now after that date we're going to be running an ecological deficit. So that's really concerning. So that would make a good segue into what sustainable development is. So, sustainable development, in essence, is defined as development that meets the needs of the present without compromising the ability of future generations to meet their own needs. So as you can see in this diagram, there's social progress, economic growth, and environmental protection. It's important that economic growth doesn't come at the behest or the sort of detriment of social progress and environmental protection, which has been the case basically since 1967, as you can see with the graphs previously. So governments in the world have recognized this. They've banded together and basically made commitments such as the Sustainable Development Goals, which is a universal call to action to end poverty and ensure that the planet and all people enjoy peace and prosperity. For that to happen, we need to take care of the climate and the people that are inhabiting our planet. So it's the global community basically rely heavily on the private sector to solve some of the most urgent problems of the world. Companies and institutional investors are being asked to contribute to SDGs through business activities. If you look at the next slide, another commitment that governments have sort of committed to agreements such as the Paris Climate Accord, which basically aims to, it's an agreement basically to pledge the collective limiting of global emissions. So they basically want to limit global warming to a maximum of 2 degrees Celsius and to drive efforts to limit the temperature increase even further to 1.5 degrees above pre-industrial levels. So obviously achieving this would require reducing global net carbon emissions to 0 before 2050. Now we're going to responsible investing. So defined as the PRI, as Mona explained what the PRI is. PRI defines responsible investment as a strategy and practice to incorporate environmental, social, and governance factors in investment decisions and active ownership. So looking at the statistics of responsible investing, or where the world's going to, 78% of the world's biggest companies integrate non-financial data in their annual financial reports. 22.9 trillion is the total sustainable responsible impact assets under management in 2016, up 25% from 2014. 49% of shareholders filed in basically focused their reports on environmental and social factors. And 82% of mainstream investors consider ESG information in making investment decisions. So the world is definitely taking a more ESG approach. Just to sort of elaborate on what ESG actually means and break it down. Environmental, social, governance factors are basically for environment, there's climate change, resource depletion like I was talking about, waste, pollution, deforestation, and the social factors are human rights, prevention of modern slavery, prevention of child labor, sort of improvement of working conditions and employee relations, governance, which is probably a big topic in Namibia currently, for us to prevent bribery and corruption, executive pay and remuneration disclosure, board diversity structure, and tax strategies. So yes, this is basically some of the major headlines of companies that, should I say, failed to manage sort of these risks, these material risks. BP is set to pay basically the largest environmental fine in US history because of the oil spill. Tokyo Electric executive were charged over the Fukushima nuclear disaster. The emission scandal for Volkswagen, and sort of the similar data scandal that happened with Facebook, and Tesla's share price basically. So these are basically non-financial sort of factors that could have huge financial implications for asset managers, asset owners, governments. So a few responsible investment practices on the listed equity space. So asset managers on behalf of asset owners would basically utilize these practices in order to to improve ESG or integrate ESG into building portfolios. Is negative screening, exclusionary screening, which basically leads the way currently. Exclusionary screening is basically avoiding securities of companies or countries on the basis of traditional moral values and standards and norms. So that would be asset managers avoiding companies, should I say, that more than 5% of the revenues come from gambling or sexual exploitation of some sorts. And that's basically a decision from sort of value moral decision made from asset owners to say that this is where we're going, we care about the environment, we don't want sort of deplorable social negative companies where our money is going to be invested in. So these are some of the practices. Corporate engagement, yes, all of that. If you look at the trends, a lot of, or most assets by strategy, asset managers basically use a lot of negative screening. A lot of it's happening in Europe. I mean, Europe does have sort of stronger mandatory disclosure requirements, so they definitely utilize ESG investment practices a lot more often. So then there's responsible investment practices in the private equity space as well. We're at MONASA are actually engaging in a lot of this at the moment. We do ESG screening and due diligence during deal sourcing, or that's one of the practices that could be utilized. Including material issues in the investment memorandum as part of the investment decision, active ownership by managing ESG issues from the fund manager during onboarding, engagement and monitoring of the portfolio company, and adding value at exit. So, because private equity companies are basically in investments for a short period of time, it's important to, yeah. So yes, we've actually been doing some work with Ongos Valley Development. I'm glad to see that Reagan Gregg, representative of Ongos, is here. We've been doing some of their reporting. Definitely helps with their disclosure as well on ESG matters. If we report throughout all phases of the development, from construction all the way to operation, we came in right at the beginning, so that's very helpful. And they're doing great. I think we helped with the environmental social management system, and yeah.
And the policies.
And yeah, and the sustainability policies, which is basically a communication to the world out there what they're trying to achieve from a sustainability perspective. So the importance of reporting and disclosure. So ESG reporting is an organizational practice of reporting publicly on economic, environment, social impacts, hence its contribution, positive or negative, towards the global sustainable development. It helps organizations develop sustainability-related strategies, helps to set goals and measure performance. It empowers businesses and stakeholders to improve decision-making, enables more accurate assessment of value creation, resilience and health of a company. It is stakeholder focused, performance bridging, and marks continuous improvement, and helps build trust and confidence in business markets. Why do we report responsibly? Why it matters? Well, reporting helps connect decisions made in the financial world to the real world impact. It enables us to make decisions about capital allocations, to get an insight into what your money enables others to do, and what it means for basically the natural and social environment in which your investee operates. Reporting as a strategic tool exercise, or strategic exercise and a tool for enabling sustainable decisions. And the report itself is a dialogue starter for engagement and ESG performance improvement, which in turn leads to lowering risks and positively influencing the stability of the company and securing returns in the long term.
those are the features basically of an ESG or good ESG report. It has to be concise, consistent, current, and comparable. And I like to highlight comparable. That's why there are certain sort of provisions and guidance notes that are provided globally for people to basically have their reports in a more uniform manner. Industry-led sort of organizations that provide sort of uniform taxonomies for reporting on some of these issues, make it easier for the media and stakeholders to decipher what some of these reports entail. So, yes, since the 2000s, basically a range of industry. So, going back to the SDGs, basically, the SDGs can serve as a framework that influence the formulation of reporting provisions. So, this is a nice graph that basically illustrates the number of reporting provisions linked thematically with individual SDGs in 2020. A large number of them are in SDG 12, which is basically responsible consumption. That's what I was talking about earlier with the graphs. And also justice or promoting justice, SDG 16, promoting justice and strong institutions. I don't know the wording exactly, but those are basically the two themes which are trend-wise are the most linked thematically. So if I'd like to sort of illustrate a case study of what was happening in Colombia, the government of Colombia has taken a proactive approach to engaging businesses and contributing to their SDGs by 2030 and report on their progress. So in 2017, the government of Colombia, Argentina, Chile, Brazil worked with the UN Environmental Program to develop a 3-year project for enhancing the capacity to manage information from corporate sustainability reporting in the region. So they're involved to basically create a platform for companies and SMEs to engage and disclose some of their reporting information on a website, on a platform, which everyone can see. For Colombia, the selected subsector was fish, shellfish, meat, and meat products. Workshops were held to assist businesses in initiating or advancing their sustainability reporting practices and collect input for the development of sectoral guidelines. So, yeah, like I mentioned, the outcome was the development of a national reporting platform for corporate sustainability reports, which links to the reporting guidelines for the fish and meat sector, which was very helpful. So, in terms of disclosure and reporting, thank you. Change the slides. Regulatory requirements for disclosure for non-financial sustainable information would need a combination sort of a carrot and stick approach. The right combination of mandatory and voluntary approaches are basically what's actually worked well in the past. Reporting requirements include, or reporting revisions which would include reporting requirements include public laws and regulations, self-regulation bodies such as MONASA and also the Task Force for Climate-Related Financial Disclosures and GRI, the Global Reporting Initiative, and the Sustainable Accounting Standards Board with its materiality topics for select industry sectors. So these are basically guidelines and codes that help reporting on ESG issues become more effective. So the last 2 decades have shown how non-financial sustainability reporting policy landscape has matured. Regulators such as MONASA and MONASA and also the NSX basically have sort of a combination of mandatory reporting or voluntary reporting. I think NSX has a sort of voluntary, it's mandatory, okay, mandatory reporting mechanism as well. So these basically help institutional investors and investors disclose on material ESG issues which they are currently facing and fighting. So yes, I think, yeah, that's my presentation. I'd just like to end this with a quote from Michael Bloomberg, who's the TCFD chair. Increasing transparency makes yes, more efficient and economies more stable and resilient. So yes, thank you very much.